Hi folks, Rick Wedell here. I'm the Chief Investment Officer with RFG Advisory in Birmingham, and today is Friday, March 20th, and I thought I'd come to you with a brief market update, let you know what's going on. As I talk right now, the S&P 500 is basically flat. It's at about 2,400 for a price level, and coming off a day yesterday when we closed up a little bit. We're testing to see if we can actually put together 2 positive days in a row. We haven't really been able to do that since the beginning of March. And so I think today will be an important test for sentiment in the market as to whether or not we can actually put together 2 positive days in a row. Certainly the technicals in the market are a little oversold at this point, and so there's a little bit of a technical background behind a positive updraft in the market. So we'll see whether or not that's enough to overcome what has increasingly become, a little bit of a tug of war between both fear and greed. And we're going to talk about that in a little bit in the video. In terms of what's going on nationally, obviously the coronavirus case count continues to increase rapidly. That's not so much a function of the spread of the virus, if you will, as much as it is a function of the fact that we're just now getting testing kits into most people's hands. So we weren't testing really that much prior to this week. Now we are testing a lot more frequently and testing a lot more people. And these are people that may have been sick for a while, but we're just finding out about it now because we just have the availability of the tests. So we'll have to see where that number kind of levels off. It's certainly hopeful that we'll get the exponential growth associated with it behind us and then start to see the curve level off. But, we'll have to see how that moves. That's obviously frightening people, as are the implications for the number of healthcare beds that we're going to need and some of the emergency measures that are being put in place by places like California. Even here in the state of Alabama, closing non-essential businesses, et cetera, that economic fallout will be felt for a while. That's being offset in the marketplace by the massive amount of federal government intervention in the markets, whether it's interest rates at zero, whether it's the actions that the Treasury is doing to inject liquidity into the marketplace to ensure the capital markets function, whether it's the proposals by Congress to incentivize consumer spending. All of that potentially creates an economic powder keg, if you will, on the other side of this, to where you could see massive growth once the disruptions associated with the virus sort of go away. We are in the early innings of seeing those disruptions. Companies are just starting to announce layoffs, and I expect that those layoffs will continue. Most of those companies are doing everything that they can to try and save some of those impacted workers. And if we're honest, consumer spending is going to be down because people can't get out and spend. But I would just caution that we are in the early days of seeing exactly what those economic disruptions are going to be. The economic news in terms of the total number of layoffs, et cetera, is likely to get worse next week as opposed to better. So anyway, with that as a backdrop, I think I'm going to come back briefly to the topic of floors. We frequently get client questions around, where is the bottom? What does the bottom look like? Should I be investing now? Should I wait a week? Should we calm down a bit? And the thing that I would just try and caution people is, frequently when we talk about financial markets, we kind of talk about it the same way that we would talk about navigating over land, right? So I don't know if any of you were Boy Scouts. I was. And they taught you that, if you need to go from point A to point B, or you want to travel, let's say, due east for a couple miles, the easiest way to do it is to take out your compass, figure out what direction east is, pick a point that's along that line of travel, and then put your compass away, walk to it, and repeat the process until you're where you want to be. That's sort of, that's the same way that we think about modeling financial markets. We think about, okay, where are we going to be a month from now? Okay, once I get to where I think that is, what does that look like a month after that? What does that look like a month after that? And that's the normal way that we approach this business. The problem is that when times get exceedingly volatile, like they are today, that question of where are we a month from now is very, very difficult to know. And so it's frequently helpful as you think about investment decisions to sort of shift that time horizon to start asking yourself questions around, okay, I'm not necessarily sure where we'll be at the end of this month or at the end of April. But I do have a little bit of a sense of where we might be 12 months from now, where we might be 18 months from now, and letting that longer time frame actually guide your investment decisions. If you're putting new cash into the marketplace, probably not a terrible idea to dollar cost average, over the course of a couple of days or weeks, so that you pick a particularly bad or a particularly good day to put that money to work. But for general investment decisions, if you're thinking about either bringing money into the market or potentially taking money out, just have that longer term perspective in mind, because I think it'll really help you with your decision-making process, and also help to make sure that you're thinking about the right thing in terms of a long-term decision as opposed to more of a short-term motivation. So with that, I hope you guys have a wonderful, wonderful weekend. As always, if you have any questions, please feel free to reach out to me or your advisor, and I look forward to talking to you again soon.